Hi, I'm Ryan, the Frugal Analyst. This year, loan rates increased at the fastest pace in history. Mortgage rates doubled from 3% to more than 7% in less than a year. How does this happen? I will attempt to explain how the Fed affects the interest rates for all loan products. Let's start to imagine the simplified players. Starting with the bank, they sell loan products to borrowers like mortgages, credit cards, auto loans, business loans, and more. The bank takes in deposits and maximize their return by charging fees and interest. They can also invest their money in safe assets like treasuries, government bonds, and even loan money to another bank. Their job is to allocate money in the right place to maximize returns. Now, the banking business is regulated by the Fed. The Federal Reserve sets rules and access for banks to operate under. The Fed does not set the rates for any consumer loan product. Still, the financial markets are deeply connected that changes in the Fed guidelines impact loan rates. I'm going to go over the complexities and give some examples. Starting from the Fed, one of the Fed guidelines is to set the target for the federal funds rate. You might hear this a lot in the news. This target rate has been increasing to combat inflation. This rate is defined by the interest rate banks charge to lend to each other. The Fed sets the target range, but they don't set the actual rate. The banks themselves set the actual rate. To hit the range, the Fed can incentivize the market using policy tools such as open market operations, changing the discount rate, setting the reserve requirement, changing the interest on federal deposits, and many more. Let's go into an example. One of the primary tools is the open market operations, or previously called quantitative easing. This is when the Fed buys assets like US Treasuries and mortgage-backed securities. When the Fed buys, they can buy in trillions of dollars, so their impact is significant. When we look at the mortgage historic low rates, the Fed bought big time. The low mortgage rates in late 2020, early 2021 were probably something that investors wouldn't want to buy naturally because the interest is so low, but the Fed bought it anyway, driving rates down to less than 3%. On March 2022, the Fed open market operations or quantitative easing stopped. The Fed didn't buy any more treasuries or mortgage-backed securities. As a result, demand for those assets dropped, and interest rates increased to balance supply and demand. Looking at treasuries in the past year, rates have moved higher since then. So why does this matter? Well, looking back at the players, when the low-risk investment pays a higher rate, the banks need to consider where they should deploy their money. Should the bank buy treasuries instead of lending? They are always trying to optimize money. When they find something with a higher rate of return, they are less willing to lend to other banks at the same low rate. Basically, the opportunity cost is higher. This creates a chain effect that increases the Fed's funds rate and ultimately increases the bank's cost of doing business. Now, this is an example with one monetary policy. Actual execution involves multiple policies implemented simultaneously, and that's the Fed's job. Now that we know how the Fed policy impacts the bank's cost of funds, how does this rate affect actual loans going to the borrower? As the Fed funds rate increases, it's more expensive for banks to borrow money, and someone has to pick up the cost. Most of this cost is pushed to the borrower through higher interest rates. Looking at an actual loan product, loan rates are typically set based on a few components such as the bank's cost of funds. How expensive is it for the bank to borrow money? The cost of origination, like the paperwork, the people involved, the buildings. Default expectation, how many people are not paying back their loans? And a profit margin. The banks are a for-profit business and they need to make money. As the cost of fund increases, so do loan rates. So to answer the original question, how did the interest rate jump so much this year? The Fed's guidance took a U-turn from historic low rates to rapid increases in a very short amount of time. The Fed did this by changing the incentives on the background, and ultimately, the interest rate effects are pushed to the borrowers. In this video, I tried to simplify the financial system. In reality, the system is very complex. There are market expectations baked into the cost of funds. Liquidity, or the ability for market participants to buy and sell assets in large volume, also plays a significant role in setting rates. I hope you enjoyed this explanation. Please share, comment, and give us a thumbs up. Thanks for watching, and I'll see you in the next Frugal videos.